Welcome to the Uncontested Investing Show, presented by REI Inc. magazine and sponsored by RCN Capital. Each week, we focus on bringing you candid convos from the best in the biz. Here's your host, Tim Harridge.
All right, welcome back to Uncontested Investing. I'm Tim Harridge, your host. Thanks for coming back. Today, I'm joined by a good friend, Carlton. Kurt, thanks for stopping by, bud.
It's a pleasure.
So, Kurt, just take a minute, say hello, and just tell a little bit about you and New Western.
So there's a couple of big things right now. It's getting exciting again. Obviously, inflation is the big one. That's what everybody's looking at. Nobody seems to share the opinion on how to measure it, but it's obviously here and it's big. And Warren Buffett famously, I think it was like 2012 or something, said the biggest hedge against inflation is the 30-year Fannie Mae mortgage. I mean, it's just a perfect defense against inflation. So even though rates are higher, you can reset your mortgage rate if rates go down through a refinance as long as your financial condition stays the same. But you can't repurchase a home again later if the price increases. I don't think that there's a future where home price appreciation starts to go backwards rapidly. Inventory is just at such a unhealthily low number. It would be unreasonable to think that you're going to lose home value. I think we'll be just fine on homes. That's very much separate from a lot of the other concerns in the economy right now. I think the Fed, what's different today in this potential recession that we're going into now is in the past, we didn't have as much warning and the Fed didn't do as well in giving us warning ahead of time, communicating. They didn't communicate as well. And when a recession or these issues were nigh upon us, they had to react. Well, right now, what they're doing a really good job is communicating so that the market can understand where we're heading and can slow down before they need to raise rates. So I think that's already happening. And I think, we're narrowly looking at maybe a soft landing as opposed to a hard landing, but we'll see. We'll see. So I would continue to buy real estate. I would certainly leverage fixed rate mortgages and debt whenever you can. That would be my advice, given the lack of inventory we have today.
Man, that's good stuff. So you brought up the dirty word, Fed, right? So you said they're doing a good job. You may be the only person I've heard say that. But you are right. They have given us kind of a heads up. And interest rates have doubled in 6 months, but they've doubled from not even the bottom of the basement, like under the basement, under the foundation piers, down into like the Earth's crust. They were low, right? So you think that rates could still go up some?
Well, yeah. The idea is that they'll continue to increase, right? But if you saw in 2018, we had the same issue. Rates went up, and then they reversed it. Now, who knows if that's going to happen now because, the inflationary pressure is very different than what it was
right.
in 2018. And nobody knows, where we're going to go, soft landing, hard landing. You teeter on the edge, and if you push too far, it's like a chain reaction. Everybody kind of goes. I listened to Ben Bernanke say that about 2008, about how that was potentially avoidable, which I'm not sure I believe, but it was right before he handed us a signed book and all that, so maybe he was trying to say this was post, everything. But
after I missed it, I could have not missed it, right?
Everybody just complained so much, and then they drove it to happen. But anyway, who knows? So nobody really knows. But what's different today than it has been in the past is the Fed does a lot more forecasting about what they're going to do. And that allows the market to react. It allows the slowdown that we need right now to slow down inflation and the labor cost and things like that just need to happen. So I look at this more real estate-wise, moving towards a normalization and not moving towards a recession.
It's kind of inserting stability into something that I feel like was starting to get unstable. I don't think the housing market was unstable at all yet, but a couple more years of these double-digit inclines and you get pretty unsustainable.
I mean, we're in an affordability crisis. We'll continue to be an affordability crisis. Nothing's going to change that overnight. All the programs that mean to fix that, like the GSEs, their main mission this year was to make mortgages more affordable for lower income buyers. Well, how do you do that? You lower the fees, you do that. Well, all you're doing is piling more demand into the lower end of the real estate market. You're not addressing supply at all. So you're arguably raising the cost of housing with these things. Nobody's really addressing the supply side. Now, in the Build Back Better program, there was this little tiny thing that that was much overlooked. It was called the neighborhood. I forget the name. I'll be able to pull it up. It was, but it was basically a small act that was aimed at getting flippers, fix and flip developers, creating a tax-free environment for them if they flip houses, as long as they meet a certain criteria that deems them affordable. They have to find it at an affordable price range, and they have to sell it to a buyer that meets income levels. I think it's like 80% below the median local income. And that would qualify all the proceeds on that flip to be tax-free. Now, that was the only plan that I've seen that actually addresses the supply. Because as you know, there's 16 million vacant homes in the United States right now. Some of them are vacant. And that's like, I mean, you know how many homes there are. That's 15, 12, 15% of the inventory.
Right.
Now, some of them are vacant because they're an Airbnb, right?
Right.
Some of them are vacant because I heard a story the other day from an individual at a dinner party. Years ago, she had inherited a rental house. It was kicking off rent. It was in Arkansas. She was in Texas. And there was a fire, right? And she just didn't know what to do with it after that. She wasn't really equipped, to figure out how to reposition that. She didn't want to go to Arkansas and work on that. But it was vacant for 3 years.
Wow.
With fire damage. And now who knows how that went with code enforcement in the neighborhood and everything. Maybe Arkansas is a different thing than maybe DFW here.
I can tell you, if it's still vacant with fire damage, I can tell you what it smells like.
But 3 years until they decided to sell it, they sold it to a local investor. But there's a lot of situations like that where houses are just vacant for no good reason. And when you have an inventory crisis and an affordability crisis, having the local fix and flip mom and pop operators that really know the market and providing incentives like that for them to find those units and return them to market, a net +1 housing unit. I mean, the effect that has on the local housing market is tremendous. It's the only thing that will really work. You can't build fast enough right now. The builders are so spooked by the rate environment. They're all slowing down. Land prices are insane. Until just recently, lumber was crazy. Now it's cut in half, and it's starting to become sane again.
For this month.
But you'll see some of that supply chain stuff work itself out. Maybe we'll see. But still, the builder environment, it's a long planned. There's a lot of risk in that. You get that machine going. You can't pull back when markets change. That's why in 2018, when rates rose, we lost 18 to 24 months of building inventory when they pulled back and they had to build back up. So the answer to housing inventory is the existing stock, to finding these distressed houses. And this is probably not going to be a big mega institution that does this. Flipping houses is not scalable.
Right.
The iBuyers like Open Door and these guys, they're not buying houses that have unpermitted additions and foundation damage and burnouts. Like they're buying houses that have lipstick, right? So you really have to lean on this local flipper that I'm not sure if the market still views that person as somebody that's, part of the problem or the solution, but they're really the solution these days. They're the hero. They're the people that are taking the personal risk, slaying the dragon. They deserve the gold, right? But they're fixing the market for us. So I don't think they get enough praise as far as how to engineer us out of this inventory crisis.
I was at a city council meeting in my hometown last night because I have this large 150-year-old house that I'm repositioning, and we're going to subdivide and build some more housing units. And I'm meeting some resistance from the historical board. And
Freudian slip. Yeah,
right. And I made that point. I said at the meeting, I said, I'm not the bad guy. As a matter of fact, my wife and I have invested over $2 million within a half a mile of downtown in the last year, taking the ugliest vacant houses in the neighborhood and making them the nicest houses in the neighborhood. And So I'm with you. All hail the local flipper. And when we come back from break, you've given me so much to unpack. It's going to take a lot. So stick around. We'll be right back.
Are you looking for fast funding for your next fix and flip? What about leverage for your next long-term rental or vacation rental? Need capital for a new construction project? Look no further. RCN Capital has you covered. As the leading nationwide lender for real estate investors, RCN Capital offers short-term and long-term financing solutions for your next investment property. RCN Capital takes a common-sense approach to your loan request, offering high leverages and low rates backed by superior customer service. Whether you're investing in single-family properties or multifamily properties across the U.S., RCN Capital has funding options for you with no hoops to jump through and quick closings in as little as 2 weeks. Ready to get a quote for your next investment property? Visit rcncapital.com/podcast to apply today. There is no fee to apply. Again, that's rcncapital.com/podcast to apply today.
Welcome back to Uncontested Investing. I'm Tim Harrod, your host. I'm here with my buddy Kurt Carlton. And Kurt, man, you hit all of the top line headlines for me. Inventory, affordability, supply and demand. Somebody said the other day, supply and demand is undefeated. And when you look at the decline in home building after 2008, and then the pullback in 2018, and then the pullback last year when materials and labor just shot way up, and now the pullback, if you look at home permits, it's pointing down. But if you look at the population chart, right, it's pointing up. And even with that thing that happened in 2020, it still points up, right? There's more humans that need housing today than ever before. And we're building less homes per capita than ever before. And now I get it, there's a lot of people living with their parents, but I like where you're going on this whole, we need to go find the vacant units and get them activated. That's smart stuff. How does the local flipper do that?
That's a great question. It's so challenging. The data, this is an area of real estate where the data is so opaque. You can see all the square footage, year bill, if somebody's paid their taxes, all that from a top-down approach on the real estate. It's public information, most of it, but you can't tell the subjectivity of the inside of the house, whether it's distressed, and so many of these situations, like that burnout situation, they come and they go, and this isn't real estate data. There's not a lot of transactions that occur in any given neighborhood. It's the largest transaction really in any major market in the world is a real estate transaction, right? So this isn't tampons at Target,
right? Where
you build a big data machine learning algorithm to find these houses. It just doesn't work. You need a lot of local. This is why the local home flipper is so important. You need a lot of boots on the ground, local, decentralized experience. You can imagine if I'm trying to flip a house nationwide with a big top-down company, and I've got this big approach to find all these houses. Imagine how my rehab is going to differ in the south side of Philadelphia versus like the homogeneous subdivision of Phoenix or something. Like it's just different. You need a local flipper in south side of Philly, and he needs a baseball bat. And that's not a scalable institutional play.
Right. That was the reason the first time that any of these funds go into local markets, the first thing they do is go find a boots on the ground entrepreneur that they can partner with. And because, like you said, they don't have a baseball bat on Park Avenue, right? But they need to know what neighborhoods they need in when they expand to Tampa, Orlando, and all the other major markets. You think we'll end up transitioning to like a 40-year mortgage in America?
They offer a 40-year mortgage with FHA right now on a, and this is largely due to the COVID, but they offer a modification right now for FHA loans. So they're already pushing people into a 40-year mortgage. Now that's probably right? They need to reset a lot of that, and the way they've handled the moratoriums and the forbearance is actually probably been pretty good. Right. It's avoided a lot of heartache and damage, and I think moving someone into a 40-year in that situation is probably good. I don't know that we'll offer a 40-year, but probably. I mean, that's probably, I mean, how much more unaffordable can houses get? Right. You have people that can't afford houses, but you also have people that can afford houses and just can't. There's individuals graduating from college right now at TCU with a degree in finance, getting married, $200,000, $250,000 combined income right now, that can't buy a house, not because they can't afford it, they can't find one.
Right.
They can't take 40 hours off a week of work to just make bids all day long to try to win. So,
but is the investor the problem? I read recently that the Dallas City Council was attempting to limit the number of homes, or not attempting to, I should be correct, was considering limiting the number of homes an investor could own or buy in the city. And then you read the articles about how the investors are pushing the homeowners out of the market. What's your take on that?
I think when people get really upset, they can't afford a house, they want to, buying a home is a way, it's the fastest way to generate wealth, right? The most reliable way to generate wealth for the average American, right? So when you take that away, that's a problem, right? With all that's going on right now with disparity, that's an issue. So I think when people become angry, your local lawmakers look for solutions. Now, in California, that's rent control, right? Well, every economist on both sides of the aisle agree that rent control is like carpet bombing your city, right? And maybe has some degree where it works, but so to say that we shouldn't allow investors to buy houses is so broad,
right? And
they have bad data. Now, the most recent data for Dallas Fort Worth here was close to 40% in Dallas, or almost 50%, close to 40% in Fort Worth, investor purchases last quarter of all the homes on the market. So that's pretty crazy. That's wild. Now, since then, all the funds have sort of put on pause because rates have increased. They have to securitize all this, and they're probably just waiting for cap rates to increase so that they don't get priced out too high. And maybe they'll come back. So it's going to be a problem. There's a lot of lobbying going on in DC because a lot of people are upset. So we'll have to work our way through that. But the answer, getting flippers that are finding houses that are not being used today and repurposing them to be a net plus one, they shouldn't fall in that basket.
Right.
And I'm afraid they will.
Right.
And some politician will come in with not enough data and will just make some big sweeping thing that ends up being tremendously popular to their constituents. And they push that out there, and it gets them into a deeper hole than they are today.
Last week I was on Twitter and I noticed a tweet from BlackRock, not Blackstone, not Blue Rock, BlackRock. And the tweet said, setting the record straight, BlackRock doesn't buy homes. And I was like, really? They're promoting this? And I clicked on it, and it talked about their investments in the paper, and because BlackRock doesn't buy; they buy the bonds, from the securitizations, and they're often confused with Blackstone. But I found it very interesting that they're spending money and time to put out press releases differentiating themselves from the ones that are buying.
It's crazy right now, and I think there's a lot of misguided opinions in Washington and locally. You know very well because of your background. I mean, the mom and pops own the vast majority of the rentals in the United States. It's not the big megacorps.
Right.
So addressing just because the megacorps are going through this big acquisition spurt, or they did recently, doesn't mean you should shut the door on really everybody. You're going to cause some damage where maybe you're going to hurt the wrong target or not fix the right problem.
Well, I mean, I use this house in Rockwall as an example. I mean, it will probably be worth 1.2 to 1.5 million when we're done with it, and we paid $550,000 for it. And if there was anyone listening that wasn't anti-investing, now they'd think that I was a crook and I ripped someone off. But that home had been for sale 3 times on the MLS. No one bought it. No one made an offer. It was we've spent almost $250,000 replacing all the plumbing, rewiring the entire house, digging the foundation out of the dirt, and it's a 150-year-old Victorian house. So, I mean, you really can't. It's a historic landmark in our town, and it's important to me. I care about the community, but here I am. I'm taking it, and I'm actually probably the only person in the area with the skill set, knowledge, and willingness to invest my money to do that. And there's been 4 or 5 other houses around there that we did that to. We turned them from the vacant house with the hole in the roof with the tree laying down to the house $100,000 later, everybody wants to buy from me. And so I think drawing a differentiation is important, but I also think, you know, the markets, the free market's got to run. I mean, that's my opinion, though. I mean,
it's unavoidable.
Right.
If we want to be America,
Right.
you know, and have things like property rights that are respected. But that chaps my stick, what you just said. That's the one thing that just drives me crazy. Because if you look at what these investors do, everyone says, oh, they're buying below market value. No, they're not. They don't buy below market value on our marketplace. They don't. They buy at market value and they add value to the home.
Right.
And you see the creative things that these investors do to these houses, it takes a local creative person that's taking financial risk to do, right? And maybe marital risk, because you flipped enough houses to know what goes into that, right?
So 2008.
But you know, it's stressful.
Right.
It's one of the most stressful things you can do is flip a house, right? Now, some people like that and it gets easier over time. But man, I mean, they're adding so much value by doing all these things, by improving the floor plan, doing things that homeowners can't do. When a homeowner tries to rehab their own house, are they a professional designer? Do they have enough experience to know what sells? Are they just going to do repairs that need to be redone when somebody buys it? And a contractor is going to charge them a premium, right? So isn't that just what the profit is for an investor anyway? So they're just doing this thing the homeowner can't and shouldn't do and doesn't enjoy. They're taking all that away and they're adding value. What we're seeing in like Seattle right now that has severe inventory issues is they're buying these houses and they're building these nanny pads in the back, adding, taking one housing unit, turning it into a net 2 housing units. They're just doing all these creative things that really help the area. And they shouldn't be looked at as somebody that's just taking advantage of somebody and buying under market value and just stealing equity, I guess.
Yeah, I mean, and it is hard. And I don't want to drive that rabbit hole because I'll start complaining about the city council. Before you know it, Kurt, we're going to be down the hall drinking a beer. So I'm going to move on. And we keep saying mom and pop. And that was one of those things that I think used to be it was almost the way that Wall Street kind of put down the local investor. But now I feel like it's a differentiation that actually it lends to the entrepreneurial spirit of the backbone of our industry and probably the people looking on your marketplace. Do you have any insight into some of the characteristics you may have seen over the years of what makes these mom and pops successful in running their businesses?
Yes. Unfortunately, there's arguably the education side of the real estate industry is maybe bigger than the real estate industry, right? There's certainly more opinions than deals, right?
Yeah.
But sometimes people have just the wrong expectations. And this is more like baseball. You don't hit a home run every time. You've got to do a lot of deals. It's a marathon. It's a career. You just get better with each one. And I think people that look at the long term, that this is a business, right? When you start a business, you have cost. Everything's not as efficient as it should be. And the idea, is to make it more efficient every year and to make your unit economics, your profit on each house more profitable every year. So you've got to start somewhere. Over time, you have to improve it, and you just have to have realistic expectations around the time it's going to take and the money that you're going to need to invest over time to build out a real business. And then the other thing that I think a lot of investors don't see is everybody thinks that you have to buy the deepest deal, right? And in this market, it's just you have to be so efficient with everything, and you need to be the guy that can pay the most.
Right.
And that means your business has to be efficient. You've got to have the right contract contractor management, the right suppliers, the right design choices, all these things in order so that you can pay the most so you can get inventory.
You actually bring up some good things that I want to talk to you about during the rapid fire section. But we're going to take a quick break. When we come back, we get the Money Minute and Rapid Fire. Stick around.
REI Inc. is a monthly business publication for real estate investors, covering all types of real estate investments and strategies. It is the most comprehensive real estate investment publication on the market. All of the articles are written by the top leaders in the industry, so investors are assured of always getting the best information possible. Each month, REI Inc. also profiles the top companies in the industry and provides insights and data into key regional markets. Along with their sister platforms, the REI Referral Network and Highest Invest, real estate investors have exclusive access to off-market investment opportunities and national acquisition and disposition initiatives. To learn more, visit www.rei-inc.com, where you can also access the REI Referral Network. Also, be sure and visit www.highest-and-vest.com to view the latest exclusive off-market assets with near immediate acceptance decisions and closing strategies. You can also email marketing@rei-referralnetwork.com to request more information.
Welcome back to Uncontested Investing. I'm Tim Harriet, your host. I'm still here with Kurt Carlton. And Kurt, it's time for my favorite part of the show, the Money Minute. Now, the Money Minute. Imagine there's a young Kurt just about to start New West or New Western, or maybe is a couple years into New Western, or a young entrepreneur that's out there thinking about getting into real estate investing, or just there's someone out there listening to this podcast, and this is the only 60 seconds of advice they're going to get all month. So you've got 1 minute to talk to them about how to be more successful, how to make more money, how to live a better life. So get your good best stuff together. Here we go, the Money Minute.
The Money Minute. What would I recommend? I would say just do a deal. People are successful because they take risks. So do a deal. Understand that it's a risk. There's a lot of people that you can sit and you can dream about how the market works and how deals work and learn and take classes and do all these things, or you can just get in and see what the actual market's like. And I think even if you do a deal unsuccessfully, you leave with knowledge, you leave with an understanding of reality of what you need to work on to improve. And as long as you're constantly improving, remember, this is a marathon. So just do a deal, learn, do your next deal, learn. We're lucky today where if you can find a deal, you're going to move it right now. I mean, inventory is the hardest part of the job, is finding a deal and being able to execute on it. So if I had any piece of advice for somebody out there, is I would say, stop learning by not doing and start learning by doing. Do a deal.
Well, Kurt, as always, that's good stuff. I suffer from, I actually have no hesitation about doing deals. I tend to just yeah, sure, that don't work. We'll buy it. I'll never forget the first time we bought this house for $3,000, and I was in Vegas at my buddy's wedding. And he came up to me, he's like, hey, we just bought this house over off of Canada for $3,000. That lot's worth 100 something now. But anyway, and I turned to him and I said, man, are you sure? That's kind of a rough neighborhood. He goes, Tim, you just lost $3,000 on the roulette wheel. I was like, yeah, well, you're right. We should probably buy the house instead. So, I mean, you can waste a lot of money and a lot of time by not doing deals. I agree with you. Just do a deal. Kurt, levers. I love levers, right? And so every real estate transaction is a couple things, right? It's what you pay for it. It's what you spend on it. What it ends up being worth on the rental or the sale market, right? And there's only, you have a little bit, the market influences what you pay for it. The labor market and relationships will influence what you have to spend on it. And then frankly, your other decisions earlier are going to depend what the market will pay for it. So there's other levers you can throw, financing or cash, and et cetera, et cetera. But let's talk about levers. Best piece of advice on deciding what to pay for a property.
That's going to be different from investor to investor.
Right.
Because some investors can pay a lot more. They have a better contract network of contractors. They have a better They know their neighborhoods. They know their design. I mean, I've been off all the time when I go in and I say, hey, this is worth 300. And some local rehabber says, no, I'll get 375 all day long for this. And I say, You're dreaming. And they do it because they just know what works in that neighborhood,
right.
and they're experienced, and they can take what's perceived as greater risks, but it's because they have the knowledge, and there's a higher likelihood that they're going to move those things. They know how to work that neighborhood.
So if you're struggling on what to pay for a house, develop market specific or even neighborhood specific expertise or understanding.
And you're only going to learn that by taking risks through experience, right? You've got to start somewhere.
I love baseball analogies. You used one earlier, right? Like you can never get better at batting without going to batting practice, right? Like
exactly.
I mean, you have to practice. What about contractors? I know a lot of people they pick the cheapest contractor and then they get the cheapest work, and then the house sells for the cheapest sale in the neighborhood, and then they're mad that it didn't sell for whatever they thought it was going to sell for. It's like, well, yeah, but So, any advice on selecting the right contractor?
First of all, you need to have a lot of contractors, right? Because they're going to shift, and they're going to, contractors are contractors. I'm going to get murdered for saying this, but contractors are contractors because they can't get out of bed in the morning, right? So they don't fit into the rules of society, right? So they go become contractors, which is great. They're just different types, right? And the world needs all different types. But they're going to do their own thing, and they'll be with you, reliable, and then they'll be gone. So you need a big network. And what I found best with dealing with contractors is just have a very tight, put the work in ahead of time to have a really tight plan, a work plan, right, together of exactly what you want to do to the property. The design is just so good up front. It's just like with anything, any project, software development, anything. Spend all your time on the design. And then when you turn over to the contract, if you hand over a solid plan that's detailed everything you want to do, they can't paint this big picture and say they're going to do that. And then when you get into it, what happens when you get into it? Oh, you didn't say that. Oh, I didn't know that. Yeah.
That's going to be extra.
And if you put the time in to have a really, if you put in your details into your spec ahead of time, then it's really easy to get multiple bids. In some cases, if you got the floor plan, you got anything, they may not even need to visit the property.
Right.
Depends on what they're doing, whether it's plumbing or cosmetics and all that. You can rapidly get bids, and when you put them in this competitive environment, you don't have to play the games where this is the contractor and you just got to go with him because he's the only guy in town. He's going to, you can kind of span out and actually get a competitive environment.
I like that. So now the lever of we'll just say the market value on the backside, right? Rent or resale. So what are some tips to maximize that?
What was the question again?
The tips to maximize the most you can get in rent or the most you can get in sales price.
There's an interesting study that just came out now out of A&M where they looked at institutional landlords versus local and what they do as far as amenities and how they're able to charge higher prices. And you should Google it and look it up. It was in the Dallas Business Journal recently. But they're really starting to crack that code, because if you're a mom and pop, you're all over the place with what works, right? The local environment as far as commanding rents and things like that. But there's probably a lot of information in that document for some of the things you can do to follow those trends.
And I think the same way you talked about the nanny pads in Seattle, right? It's really, and I guess you just tied it all together for me. If you've got a good contractor that can execute your plan, and your plan's based off of local market knowledge and focus and understanding, then that's what will get you the most on the back end.
I think so.
Yeah.
Yeah, I'm hesitant to answer that because it's so subjective. I mean, it's really all over the place.
Well,
sometimes you'll do a deal. You've done this deal, and you do everything right, and it just doesn't sell. And you'll never know why. Yeah. It just happens, time to time, and you always second guess why didn't this work? It was just like the other three I did.
Yeah, it happens to me. Like I get the credit for those, and my wife gets the credit for the other ones that worked out, right? So, what's the most you've ever made on a house?
I'd rather not answer that.
Okay.
Not in this environment.
What's the most you ever lost on a house?
The first house we ever did was in Irving, a subdivision of Dallas, and it has an underground river running through it, Cottonwood Valley over there. Horrible foundation. Yeah. Didn't know anything about Texas foundation. I just moved here. And, they fixed the foundation with a car jack underneath it, pick it up and drop it, right? And as they were doing that, it was a pier and beam house. Well, first it rained for like 3 weeks. and we couldn't do the foundation. And then they started on it. And as they were picking it up and dropping it, bricks were falling off the side of the house. It was just a nightmare. And the windows went through kind of being some way straight to starting to look like a cartoon house through the process. We had to replace all the windows, right? But it was just a nightmare. And that was a disaster. And that was probably the worst. I don't know if it was the biggest financial loss, but it was certainly like the largest emotional scar. 3,008
cedar brush. That was my. I respect that you don't want to say the win, but you're willing to share the loss. That's respectable. Kurt, as you look at, let's call it the next 6 months, what's the biggest opportunity you see in the real estate investing market?
I would say anything that's affordable housing. Anything that's affordable housing. There's all this news about all these people just got priced out of being able to buy a house, which is true because rates went up, right? But rates will come back down, right? And what's happening in the interim is all these people that couldn't get a house are now shifting into it. It's kind of like this environment, I think, and I may be corrected, we'll see. But I think we're entering this space where maybe you had 10 people bidding on a house and now you have 3, right? It's not normal yet, but certainly a little bit easier. And I think as you move down the affordability specter, the lower you can go, neighborhoods we never thought would ever be where you would go to invest are really turning out to be some nice spots right now.
I remember when we used to say, wait 21 days and then look at your pricing product presentation, make any changes. If you need to lower the price or whatever, wait another 21 days and then make another. And because you had to give it a full 2 or 3 weekend cycle, right? And now it's wait 21 hours and, and so it would be nice to get, I'd say, closer to the median because that balances it out. I agree with you. Affordable housing is the play. Creating inventory, the net plus one. I really like that, Kurt, because that's there's a lot of small time, quote unquote, mom and pop local investors that do stabilize neighborhoods and create inventory, and I don't think they get enough credit for it.
Yeah, they don't.
Well, Bud, parting thoughts, parting shots?
I would say things are going to probably get a little bit exciting again, right?
Yeah. It's been a while.
These are going to be the days, again, like we had in 2008, not as bad, but where things were interesting and they were different, and you're going to be able to talk about it in the future. Like, remember 2022, 2021? So it's a fun time to be in real estate.
For the first time ever, I'm actually playing the equities game because I feel like this cycle could be there too. So I hear you. It is going to be an exciting 6 months. If people want to know more about the New Western and the marketplace you've created, which is the largest in the business, in my opinion, where do they go?
NewWestern.com.
NewWestern.com. They don't call you.
We need more people.
We need more people.
We need more people willing to fix houses.
Net plus one.
Net plus one.
Net plus one. Kurt, thanks for being here, man. So thank you for listening to the Uncontested Investing Show. I'm your host, Tim Harridge. Remember, your network is your net worth, and today you've been growing both. We'll see you next week.
Thank you for listening to the Uncontested Investing Show. Questions about today's episode or the podcast? Email podcast@rcncapital.com and make sure to follow RCN Capital on Instagram, LinkedIn, and Facebook. See you all next time. The preceding program is furnished by RCN Capital, LLC. The information provided is for general education purposes only and does not constitute any legal, financial, investment, or other professional advice. The views, thoughts, and opinions expressed of any speaker are the speaker's own opinion and do not represent the views, thoughts, and opinions of RCN Capital, LLC. No information contained in this episode should be construed as financial, investment, or legal advice from RCN or any individual, author, host, or guest. You should always consult a financial advisor before investing.